Hey, what's going on, y'all? I'm about to give a brief presentation on warrants and exactly what are they, the different types, the importance, and the potential gains of warrants. Right into it. First off, what is a warrant? Well, we consider it a derivative that confines to the right, but no obligation to buy or sell a security, normally in equity, at a certain price before expiration. Right. Now we're going to break it down a bit. First off, a warranty is usually issued by the actual company itself. No outside parties are involved. They are traded over the counter more than an exchange. They cannot be written by investors. They are very dilutive. They are they don't pay dividends. They don't come with rights to vote, and they are heavily traded overseas in countries like Japan, Hong Kong, Germany, you name it. That's where they trade. Alrighty. There are three types of warrants. There are traditional warrants, there are wedded or wedding warrants, and there are covered warrants. Traditional warrants, basically, they're issued in conjunction. They're basically combined with bonds. So the short terminology of it is a warrant linked bond. Whereas wedding warrants, they aren't detachable, and the investor has to surrender the bond or preferred stock. The warrant is wedded to in order for it to be exercised. Cover warrants are usually issued by banks other than companies, so there really isn't no new stock issued when cover warrants are exercised. All right. Now for the importance of it. Um, Here's are a few things to consider um, as a significant factor. They are not the same as call options. They are also not the same as stock price rights. The securities with the tax warrants allow their holders to participate in the price appreciation of the underlying security. This opportunity to practice in the upside of another security gives investors a little diversity. So this is actually a way to mitigate the risk. Some potential risks include uh, time decay or erosion of time value, or in other words, I guess you could relate it to uh, call it time depreciation, if you will. And another couple risks consist of warranty prices either rising or falling. A couple examples of actual risks of warranty prices rising. Let's say a company of ABM, they have a start warrant price at 97 cents. Um, and there's stock prices tripled in March 17th, 06. They went from 97 cents to $2.91 over that time period. Around this time, the warrant price will jump from 20 cents to the dollar to $1.86, which is usually represented as a 9.3 fold increase. And an example of a warranty price falling consists of the same example, but this time the warranty price dropped from 97 cents to uh 49 cents. Right here, it it depicts that the warrant price dropped from 20 cents to the dollar to basically nothing. So overall, if the stock price remains at 97 cents, the warrant price will fall to zero when the expiration date is fastly approaching. All right, and some gains include low prices leading to higher gearing and leverage, also capital gains. All right. An example of this is Warren Buffett's Berkshire Company making an investment in Bank of America in 2011. A brief background of this: Berkshire basically made a deal with Bank of America in 2011, decided to invest in them with their exercise price of $7.14 each. They paid about $5 billion at their stock at Bank of America stock price of uh, about $25 a share. The Oracle of Omaha, they exercised the warrants into a stake worth more than $17 billion. That's basically reflected on uh, a $12 billion gain on Buffett's company from his original investment. Uh, Also, warrants can offer significant gains in a bull market. They can protect an investor during a bear market, and that is basically it. So, leave any questions if I um, miss anything, if I can elaborate on anything. Feel free to leave comments. Thank y'all for listening.